Good morning, learners. I again welcome everyone and thank you for joining this session today. I myself Priyank Sharma from School of Management Studies, Swami Rama Himalayan University, welcomes you in this session. In the today's session, we will talk about the dynamic relationship between ESG and financial markets. ESG stands for environmental, social, and governance, and its relationship with the financial markets. So, ESG has evolved significantly over the past decade, transforming from the corporate and social responsibility measure to a core investment and risk management strategy. With increasing pressure from regulators, consumers, and investors, organizations are thinking how they operate in ways that align with broader societal and environmental goals. So, today I will talk about through or walk through the fundamentals of ESG markets or mechanism in integration into the financial decision making and the implication for the future. So, now let us start the what is ESG or exploring with the ESG. So, to begin with, let us start with definition of ESG in more detail. So, the environmental component includes a company's efforts towards sustainability, climate impact, mitigation and stewardship of natural resources. So, social criteria involves how a company manages relationship with employees, suppliers, customers and communities. This includes diversity and inclusion, labor rights and health and safety standards also. So, the governance relates to leadership structures, corporate ethics, transparency and shareholder rights. Together these three pillars represent a holistic approach to assessing business transactions not captured in traditional financial statements. So, companies that understand and imagine ESG risks have better positioned to navigate challenges such as climate change, societal inequality and governance failures. So, what is the role of ESG in the financial markets? Let us understand this concept also. So, the financial sector has recognized the value of ESG, that is environmental, social and governance, as both a risk and opportunity lens. ESG ratings are increasingly used in lending decisions by the banks, equity analysis and portfolio construction. Financial institutions used ESG data to determine the creditworthiness of borrowers, the long-term prospects of investments and the ethical alignment of funding allocations. Say for example, a manufacturing company with high emissions and frequent labor violations may be viewed as a high risk borrower. On the other hand, a technology firm with clean energy usage and strong data privacy standards may attract significant capital. Therefore, ESG considerations now influence capital flows also, affecting how resources are distributed across the economy. So, let us talk about the mechanism of ESG integration. So, there are several mechanisms through which ESG is integrated into financial systems. So, the one major tool is use of sustainability linked loans. These are credit products actually where interest rates are tied to achieving ESG performance targets. To understand this, let us have an example. Let us say a company might receive a lower rate if it reduces its carbon footprints or improve its board diversity. So, green bonds are another mechanism. These debt instruments finance environmental friendly projects such as renewable energy or clean transportation infrastructure. On the investment side, if we talk about ESG screening is used to eliminate companies that do not meet ethical standards. So, positive screening meanwhile highlights firms with strong ESG metrics. So, this approach not only supports responsible business practices but also helps investors to minimize exposure to ESG related risks. Now, what is the financial impact of this environmental social governance? So, numerous studies which conducted in the previous years shows that companies with strong ESG profiles tend to outperform in the long run. This is often due to enhanced operational efficiency, better stakeholder relationships and stronger risk controls. So, ESG factors can also serve as early indicators for financial performance. For instance, a company with a poor governance is more likely to face scandals or regulatory fines, while on the other hand, those with social strong programs may experience higher employee retention and productivity. So, it is important to note however that the financial impact of ESG varies across sectors. In capital intensive sectors like mining or energy, environmental risks carry greater weight. In contrast, tech companies may be judged more heavily on data privacy and labor practices. What are the empirical evidences of this particular concept? So, empirical data reinforces the link between ESG and strong financial performance. A large number of companies or large number of academic and industry studies over 2000 globally demonstrate that high ESG scores are correlated with the lower cost of capital, higher stock performance and reduced volatility. For example, let us talk about a 2021 meta-analysis by NYU Stern School of Business found that approximately 60% of studies also shows a positive relationship between ESG and financial returns. So, these findings are consistent across both emerging and developed markets. So, furthermore, ESG investments have shown resilience during period of market turmoil such as the COVID-19 pandemic, when sustainability focused funds generally outperformed the broader market. Now, coming to the role of financial institutions with respect to the ESG. So, financial markets have a significant influence on corporate behavior, though their financing and investment choices increasingly banks, insurance and asset management companies are interpreting ESG considerations into their decision making frameworks. Some of them also adopted ESG scoring systems for underwriting loans and managing portfolio risk. Other companies are also engaging with companies to improve their ESG practices or divesting from high risk sectors like fossil fuels by aligning financial incentives with sustainability goals. Institutions can accelerate the transition to a low carbon inclusive economy. Moreover, many global institutions such as World Bank, BlackRock and JP Morgan have made public commitment to achieve net zero emissions across the portfolios produced by them. Now coming to the aspect of the regulatory influences in case of ESG or environmental social governance. So the role of regulation in ESG is growing rapidly. Governments and supranational bodies or supranational bodies have introduced policies requiring companies to disclose their ESG risks, ESG targets and strategies as well. So the European Union's Sustainable Finance Disclosure Regulations, that is SFRDR, and taxonomy regulations are leading examples in the United States. The SEC has proposed new rules on climate related disclosures. Regulators in Asia and Latin America are also catching up these regulations and help standardized ESG metrics and reduce greenwashing, making ESG data more reliable and comparable. So as regulators or regulations evolve, compliance is no longer optional. So it's essential for the companies or the market participants and investors to gain the investor confidence by adopting the ESG. Now what about the future outlook? So as far as future outlook is concerned, looking to the future, ESG integration is expected to become a norm rather than exceptions. With advances in technology, companies will have more tools to track and improve ESG performance. Artificial intelligence and big data are already being used to analyze ESG disclosures, monitor supply chains and predict regulatory risk. Blockchain may also play a role in improving transparency and traceability in ESG reporting. Another key developments is like the rise of stakeholder capitalism, where companies prioritize value for all stakeholders, not just stakeholders. In this model, ESG becomes central to corporate purpose, guiding strategy, innovation and culture. So this is about the innovation and culture and ESG. So in conclusion, we can say that the integration of ESG into financial system is one of the most significant shifts in modern finance, and it reflects to a broader societal awakening to the need for long term sustainability and equity. ESG factors determining or are now being recognized as critical determinants of financial performance, risk exposure and strategic resilience. Financial institutions, regulators and companies must work collaboratively to embed ESG at the core of financial decision making. So we can say that ESG is all about the environmental, social and governance, and its assurance and its what we can say its things that we are required by the nature should be embedded into the financial systems. Thank you for the today's session. Let's see you in the next session.